Right, so let me begin tonight's numerical demonstrations on common stock valuation by giving you a little bit of a background on the valuation process itself, where we will start by considering the word value. Value. So when we say value, and let's just move out, let's use it as a generic term here, value. Value of anything, any object, depends on only one thing. Value depends on the utility. If something is useful for you, you say that this thing is valuable for me, right? If something has become useless for you, it doesn't serve you any purpose, you say this item has no utility for me, this doesn't serve any purpose at all, so it doesn't have any value then. So since value depends on utility, and when we apply this into a financial context, then the value, let's say, of an asset, any financial asset, will also depend on its utility. The same thing depends on the utility. But then how do we measure utility? Utility would be measured then in monetary terms. Once we agree on that value of a financial asset is going to be measured in terms of its utility, and then utility will be measured in terms of its monetary value, then we think about an asset. Let's say now for this particular chapter, this particular asset is our common stock. Remember, when I say common stock as an asset, when we treat it as an asset, we are looking at common stock from the point of view of somebody who has decided to invest in common stock, somebody who has decided to purchase shares in a particular company for investment purposes. But otherwise, if you start looking at the same common stock from the perspective of the issuing company, then the same common stock, you will realize, appears as a liability, as a item on the liability side of the balance sheet. So for the company, the capital, and more specifically the common stock, is a liability because this money has been given to the company by the shareholders of the company. So it's basically shareholders' money, which the company is using for its operational and productive purposes. So, but from the point of view of shareholders who have contributed the money so that the company can run, from those shareholders' point of view, this common stock is an investment, because if they are investing the money in the company, allowing the company or making the company capable enough to run its business, then they are not giving out their money to the company for free. They are obviously expecting to get something out of it. What are they expecting to get out of it? They are expecting to get some or derive some utility out of that investment. And that utility is going to be, as we said before, going to be measured in monetary terms. So if it is that common stock from the point of view of a stockholder is an asset, is an investment or an asset, then the utility in monetary terms arises from two sources. So let's just write those two sources here. One is that if we invest our money in a share of common stock, we expect that if the company is profitable, we will be receiving as investors or shareholders some part of the profit in the form of dividend. So that's one expectation that we have. So the more dividend that we get, we find that particular common stock to have more utility, more value. And then the second half of the expectation is that if we invest, let's say, $50 in buying a share from the company, then at a later date, if we can sell it for, let's say, $75, in other words, in general terms, if we can sell off the share later on to somebody else for a higher price than what we paid for it, then that will give us some capital gain. So capital gain, it's good to remember, is simply the difference between the selling price of the share and the buying price of the share. Selling price minus the buying price. So these are the two type of benefits that we are seeking from investing in a share of common stock, that we are expecting that at regular intervals in time, we will continue to receive a share of profits in the form of dividend. And when we feel that it's time to sell off the share and move on, maybe to some other company, maybe because the shares of this company have increased in value, such that if we sell them out to somebody else, we might earn a capital gain by being able to sell that share off for a higher price as compared to what we bought it for. Then that is the second part of the expectation. Nobody would like to purchase a share of stock which will eventually lead them to a capital loss. everybody wants to invest in a share, which will lead them to some form of capital gain sooner or later. But then what we need to remember now, we need to differentiate companies into two parts as before we proceed ahead. So if I just give it a broad heading here, companies or firms, we can broadly classify them into two types for our purpose tonight. One is dividend paying companies. Companies which have been regularly paying dividend over time, they have a track history, they have a track record of being profitable, and over a period of time, you can look into their, for example, the dividend per share ratio, and you can find out what has been the history of the company in terms of dividend payment to their shareholders and so on, so that you can make up your mind whether or not to buy a share in this company or not. So that can be done for those companies who have a history of paying dividends out of their profit. Remember, payment of dividend to the shareholders is not legally compulsory for a company. So if a company decided, for example, that whatever profit we earn during the year, we are not going to pay any dividend to the shareholders, instead we are going to retain all of the earnings for later use, then the shareholders of the company will not be able to take the company to the court for not paying them dividend. Dividend is not mandatory to be paid, right? There might be another situation. Let's assume that you are a startup. So anybody wanting to invest in your company, anybody wanting to be a shareholder in your company, doesn't have any data from the past to look at. You have no dividend paying history. You've just started the company. So a non-dividend paying company, or maybe you're a company who uh, just decides to retain the earnings more as compared to what you pay out in the form of dividends. So dividend history might be scarce, or it might be sparse, or it might not be regular enough to make it meaningful, to come out with a meaningful conclusion out of it, right? So such companies we can consider non-dividend paying companies. As long as we are in this realm, dividend paying companies, we can use, I'll give you a couple of names here. One is known as the dividend capitalization model. Dividend capitalization model. This can be used to find out the current price or the current value of the share, rather. Dividend capitalization model. And the other name, well, this is not a second name, it's the same, it's a name for the same thing. Dividend capitalization model is also known as the Gordon model, simply because uh, Professor Myron Gordon is associated with putting forward the dividend capitalization model. And for those companies which don't have a history or a preference for paying dividends, dividend capitalization model cannot be used because there is no dividend data available. So for such companies, what we do is we do a free cash flow valuation. And when we do a free cash flow valuation, what happens is that using the free cash flow, what we are going to arrive at is going to be the total value of the company. Instead of finding the value of the share, we will find the value of the company itself. But if you know the total value of the company, and if you divide it by the number of outstanding shares, then this value will be given to you on a per share basis. Isn't that right? So you can divide the total value into a per share value simply by dividing the total value by the number of outstanding shares of the company. We will tackle one such problem tonight when we get to that point. Right. So for as long as we are in this realm, dividend paying companies, which will consume most of our time tonight, because most companies have a preference for paying dividend, because if the companies don't pay dividends, many shareholders don't take very kindly to that, because that is one of the reasons many shareholders decide to invest in shares of a particular company. So if the company decides not to pay dividends, the shareholders will move on. So what we want to do at this point in time is we want to describe a general valuation model for those companies which fall into this category, dividend paying company. So a general valuation model, general valuation. So since we said that value of any asset, and in this case, let's express this value in terms of price today, so at time zero. So if someone asks you, hey, what will you give to buy shares in this company? So how will you decide on your response? How much should you pay for a particular company's share? What would be the fair price to pay for this share? The answer would depend on, your mind will work this way. Your mind will tell you, will first of all ask you internally, hey, if I buy the share in this company, what is it that I'm going to get out of it? That answer will allow you to determine how much valuable that share is for you. Isn't that so? And that value, when you will translate it into monetary terms, will become the price that you can or are willing to pay for that share today. So the price that you're willing to pay today for a particular share depends on what you're going to get out of it, the dividends that you're going, the benefits that you're going to get out of this share. So what are the benefits? So this company has a dividend paying history. So you're expecting that when you arrive at the next period, you will get a dividend. Let's call it D1. After that, when you arrive at period 2, you will get another dividend. When you move on to the next period, you will get another dividend, and so on. And because a company is a going concern, its life is limitless unless, of course, officially wound up or liquidated. This thing can go on. This thing can go on till infinity, isn't it? But then, since all of these benefits that you're expecting to get in the future are scattered across in the future, they need to be translated back into the present moment by using the fundamentals of time value of money. Consider each one of them to be a future value, and you can find out the present value of each of the items in this stream, and then add up all the present values. That is how much money you should pay for a share of stock today. As simple as that. You might wonder that while we were talking about the idea of value a little bit earlier, if we scroll up a little bit, you will see that when thinking in terms of value, we not only thought of dividends, but we also thought about capital gains here. So, but the capital gains are not expressed in this equation. So here is a thought. Let us say. So for now, let's just complete this equation so that you don't go back with the wrong set of information. So I'm discounting this so that I want to find out the present value. I think in your chapter, they use KS as the discount rate. They write it as KS. So since this is the first period raised to the first power, then this is the second period raised to the second power, and so on. So, but there's no semblance of any capital gain being accommodated in this equation. So let's just convert this equation into, let's just limit ourselves to only 2 time periods. Let's say we want to buy a share of stock in a particular company. We will hold that stock for, let's say, 2 periods from now, till 2 periods from now. And after that, we hope that the value of the share would have gone up enough to be considered for selling purposes. So at that time, we will sell the share, hopefully at a higher price, and take some capital gain out of it. So basically, you will write this then, that I'm going to hold the share for the next 2 periods. So after 1 period, I will get the first dividend. After the second period, I will get the second dividend, right? So because these items are future items, I'm discounting them so that I can get to know their present worth. Because unless I know the present worth of these items, how will I decide how much to pay for them in the present moment? So I'm intending to hold this share for 2 periods, after which I want to sell it off for a price which will prevail in the second period, price 2. And since this is also going to materialize at the end of the second period, I'm just discounting that back to time 0 again. So now you see that there can be a capital gain item here, because if this value is higher as compared to this value, so this will be your selling price maybe, and this is your buying price maybe, buying price. So if this difference is positive, then you would have earned some capital gain. But spare a thought for the fact that just like P0 can be expressed in terms of discounted value of its future dividends. Do you see the stream in this equation? What is P0 after all? What is the price, or what should be the price of a stock today? It is depending on what? What is it a function of? It is a function of the dividends that I'm expecting to receive in the future dividends, but not only the future dividends, actually their discounted values, discounted value of D1 plus discounted value of D2 plus discounted value of D3, and so on and so forth. So at any point in time, if I want to measure the value of a particular share, because here also you're thinking of selling off your share at a price called P2, but then what is P2? How will you make an estimate of what is P2? So at P2, if you start looking into the future, let me retrace my steps here again, going back to equation one, here, this one. If I'm standing here on the timeline, so if I make this my timeline here, time zero, this is where I'm trying to determine the price in equation one. If I'm standing here and looking out into the future, what do I see in the future? I see period one, period two, period three, four, five, and so on. It goes till I can't see beyond the horizon, maybe, yeah, till infinity. So standing here at this point, this vantage point, this is my line of vision, and I see all of these time periods in the future. But what if I was standing here? This was my vantage point. How would future look to me then? Well, this time period, this one is gone, this is past. So the future begins for me now from time three. So if I'm trying to find out the value of my share at this point in time, time two, which is what I'm wanting to do here, this one, uh, in equation three, then future begins from time three for me. So I'm looking at P2 now as a function of all the dividends that are likely to come in the future, which begins from time three and then proceeds ahead, right? And then the present value of the same thing, right? So that's why P2 again can be collapsed into simply a function of dividends, right? Going up till infinity. So so on, just for the sake of completion. So the message here is, if you look at it, is that price for a dividend paying company, price or the value. So let's just make an observation here. Price or value is a function of the present value. If you so wish, you can write the discounted value. Also, that would be correct as well. Is a function of the present value of expected dividends in the future. So that is the general valuation model that we have. So if you wanted to write it in a neater form, maybe you could have alternatively written it as this: D1, and then you want to find its present value interest factor of at KS% for the first time period, right? Plus D2 multiplied by the present value interest factor at this rate of discount for the second time period, and so on. This series will go where you know that this is nothing but D1 into 1 over 1 plus Ks to the power 1 plus D2 into 1 over 1 plus Ks to the power 2, and so on, and which can be again written as this: D1 over 1 plus Ks to the power 1 plus D2 over 1 plus Ks to the power 2, and so on. So you come back to the same place where we started from. So this is the same thing as this. Right? Any questions, folks, up until this point, or can we proceed? Everyone all right? All right, so no response, no news, they say is good news. So I take it as good news that everything is going okay. Right, so staying within the domain of dividend paying companies then and using the dividend capitalization model or the Gordon model, call it whatever you like to call it, we can, the dividend capitalization model itself, dividend, what's happening to my spellings? Dividend capitalization model can be looked at from three standpoints. One of them, the starting one, is a very simplistic one, where we will assume that dividends remain constant throughout time. They don't grow, zero growth model, right? Questionable, but then a good starting point anyway. Then we add a little bit of an element of reality, real world into it. We say, okay, no, assuming that dividends don't grow at all and just remain constant over a period of time, well, that is kind of difficult to believe. But then why this model exists is because of its simplicity. Because remember, just realize if you close your eyes for a moment and think about it, if dividends are not growing, there is no growth in dividends, then whatever has been paid out as dividend in this time period, let's write that with blue ink, D dollars were paid out as dividends in this time period. And because there is going to be no growth in dividends, it is going to be a sequence of D dollars again and again and again and again and again and again till infinity. Do you realize the same amount repeating at regular intervals, and that sequence of intervals going on and on and on without any endpoint, without any finish line? So what is this series going to become in time value of money terms? How do you see this series? It's a series of D dollars, D dollars, D dollars, D dollars, D dollars continued over a period of time. It becomes an annuity which goes on forever. And any annuity which goes on forever is known as a perpetuity. And if you have to find out the present worth of a perpetuity, what do? You simply divide it by the discount rate, which in this chapter, your textbook calls it as KS. So once you have been able to discount the series of dividends like this, because this series just became a perpetuity, and the discounted value or the present value of future dividends is what? Is P0. So computing P0 is as simple as just discounting a perpetuity. If we lived in a world which was characterized by zero growth in dividends, so it will be as simple as this. The other possibility is that we say, okay, there is some growth, but growth remains constant. The dividends don't remain constant, they do grow, but the rate at which they are growing remains constant. So constant growth model. Through some, if we decide to spend some time maybe at another time or place, maybe we can do a little bit of a mathematical juggling and find out that if we use the fundamental of, if we see this constant growth will, I don't know if you can realize this or not, something which is growing at a constant growth will eventually start to look like a series with, it will start to look like a geometric series, a geometric progression. And since the dividends are going to be countless number of items because the company goes on and on, it is simply going to become an infinite geometric series. And what we will end up doing is, at the end, we will end up taking a sum of the infinite geometric series. And when we use that, eventually we will come up with this formulation that the price of a stock today being time zero will be equal to, you start from the future at time zero. When you look at the future, the first time period that catches your eye is time 1. So you write D1 and you divide this by this KS, this discount rate, which can also be known as, that it's called required return or expected return. Sometimes it's also known as cost of capital, and minus the growth rate. So again, a very simple formula. You formulate the geometric progression, you use the formula for the sum of a geometric progression and do some canceling out of terms and compiling the terms and so on and so forth. Eventually, it will collapse into this neat little formula. The only problem with this formula is that this will work only as long as the required return is greater than the growth rate. Because if that assumption is flouted, then the denominator will become negative and your price will become negative, which is absurd. Price cannot be negative. So this model will work as long as the required return remains higher as compared to the growth rate. And then the third possibility, adding a little bit more spice to it, more reality. So we say dividends not only don't remain constant, but they also don't grow at a constant rate. The growth can also be variable. So then that will give you a non-constant growth or a variable growth model. There is no particular, though your textbook will give you a intimidating type of a formula, I don't kind of believe in kind of learning that formula because it is just coming out of these two. So if we know these two, the first two that is, then they can be used to describe a situation where dividends are growing on a variable growth rate basis. We will see that when we arrive at that point. Folks, apart from the dividend capitalization model, there are some other approaches as well. There are a total of 5 in your chapter. Do I have the space? No, don't. Let me add a page. Stock valuation models. Let's just list them out, and I will tell you what we will cover in this session and what it is that you are supposed to look up at home. The most or the majority of the chapter is going to be consumed by dividend capitalization. So this is something that we discussed tonight. Then we will, for the non-dividend paying companies, we will use this. We will take up an example of this too, free cash flow approach. Right. Apart from that, there are some other methods which are not very accurate, but they are quick, not very involved, not very intricate, nothing very difficult or tough about them. Just look at it and you understand it in a minute or two. One such example is the book value approach. I'm writing this with red font because you will look it up at home. We won't have time to talk about this. The book value approach. At number 4, we have liquidation value approach of little practical relevance, but well, it is there, so it needs a mention. Liquidation value approach. And also a more popularly used one for a quick reference to get a quick idea of what the stock's value might be today is, and this can be a handy tool, go through it. You'll find it useful in your future life as well. Price to earnings multiple approach. Very simple to understand and gives you a very quick estimate of the value of a share. Mind you, it's quick, not accurate, but you can have a starting idea. Rather than knowing nothing about the value of the stock, it gives you at least some idea about what might be the value. You can actually know the general vicinity, the general area within which the stock value might reside. Right. So it's a quick fix to find a stock's value when you have nothing else at hand. So these 3 you will look up when you are reading through the chapter. The first 2 we will discuss tonight. And right away, we go into the first of the dividend capitalization models, zero growth. Zero growth model. First up, we'll take up an example and move past that quickly. Zero growth model, which, as I told you, assumes that the dividends are going to remain constant forever. And that will allow us to see the dividend stream in the form of a perpetuity, which goes on and on. And since the discounting of a perpetuity is very simple, we can express the price of a stock today at time 0 as simply the discounted value or the future value of dividends. That's it. So on the basis of this, we have the first problem for tonight. This is that problem. Let's read through it. Scotto Manufacturing is a mature firm in the machine tool component industry. The firm's most recent common stock dividend was $2.40 per share. Because of its maturity as well as its stable sales and earnings, the firm's management feels that dividends will remain at the current level for the foreseeable future. So in the equations, when we were writing the general valuation model, I was taking the dividend stream up till infinity. Well, nothing lasts forever. So the company also, we will not last forever, and the company will also not last forever. So infinity is just another way of saying indefinitely. So we don't know when this particular trend might be broken. We just know that as far as we can think about in the future, as far as we can see in the future, this situation or this trend is going to prevail. So we can say in the foreseeable future or for maybe an indefinite period of time. So dividend per share, $2.40 per share, and that's going to be maintained for the foreseeable future. Then the first part of the question is, this is actually part A of the problem. This is part B, and this is C. If the required return is 12%, what will be the value of Scotto's common stock? So that's simple to do. If let's just put it here, P0 in this case will be equal to what? This is the dividend, and this is going to remain the same. It's going to become a perpetuity. $2.40 is the value for D. And we divide it by the discount rate, which is nothing but your required return, 12%. So if you will solve this, 2.40 divided by 0.12 will give you approximately $20. So $20 is what you should be paying for this share of stock today. In return, what you promised you will receive, you will continue to receive a dividend of $2.40 per share every time the dividend is declared. Part B, if the firm's risk is perceived by the market participants as perceived by the market participants suddenly increases, causing the required return to rise to 20%, what will be the value of the common stock? So we can repeat. And if you do this, then this will be 24 divided by 2, $12. So then part C is judging on the basis of your findings in part A and B, what impact does risk have on value? Explain. What did you observe in the calculation? When the required return was 12%, what does it mean actually to have a required return of 12% or a required return of 20%? What's the meaning? How this number has been arrived at, right? The required return, also known as expected return. So people generally feel the market is comprised of many people. The market generally feels that for a company which has characteristics similar to Scotto Manufacturing in this case, for similar companies, depending on how risky they are, right, and what state of maturity they are in, it might be reasonable to expect an earning of 12% from such companies, because 12% earning or 12% return would be sufficient compensation for the risk that has to be undertaken to hold a share of common stock. Everybody knows, maybe you're also aware of the fact that investing in common shares or equity shares is risky business. Stock market is risky business. So every time you take a risk, you just don't take a risk for the fun of it. You are expecting something, you're expecting to get something back, some return. So the higher the amount of risk you're willing to take, you expect to be rewarded for it commensurately, handsomely, right? So it is a general feeling by the market that for companies which fall into the risk profile of something like Scotto Manufacturing, for such class of companies, maybe a 12% return on equity investment is a reasonable compensation for the risk that has to be undertaken. Which means that whenever you look at required rate of return or discount rate or expected return, it is simply, remember this, a proxy for risk perception, proxy for risk. Because risk is something, is a feeling, isn't it? It is something subjective. How to have a numerical estimate of that? Required return provides us a number to look at. Basically, we're trying to quantify something which is generally subjective in nature. The risk is a perception, a feeling. Well, it depends on the risk tolerance also of individuals, right? But here we are talking about a collection of individuals in the form of a market. So the general feeling, there might be exceptions, but the general feeling is that a company like a Scotto Manufacturing company might have a 12% rate of return as a justifiable rate of return for the amount of risk involved with it. But if this perception of risk in general increases, if the market in general starts believing that the company has suddenly become riskier than what it was before, so that increase in risk perception would be reflected in an increased required rate of return. It won't be 12% will not be enough. Then they will need something higher, which is the case in part B, where the required return jumps to 20%. And what happens? What happens to the value of the stock, right? Comes down from 20 to 12. The more risky you perceive a company to be, the lesser you will want to invest in it unless sufficient reward is available. Otherwise, you won't like to buy the share. If you won't like to buy the share, then the demand for the share will fall. And if the demand falls, the price of the share should fall with it. So that is what you see happening. From $20 per share, it is falling to $12 per share because though the risk has increased from 12 to 20%, the reward has not increased. The reward still remains the same, $2.40. Therefore, something has to give. So now if you have to continue to get $2.40, the same reward which you were getting earlier in part A, but now the same reward comes at an increased risk. Now the share is not as valuable as it used to be before, so that you will be willing to pay a lesser amount for such a share, right? So maybe if you're writing a response for a question like that, you could say that if the risk perception increases, it leads to an increase in the required return. And as the required return increases, the stock price declines. Mathematically, you can see the fact that as the denominator will increase, the end result will fall, right? So if you raise the denominator from 0.12 to 0.2, then obviously the value of P0 is going to decline. Any questions, ladies and gentlemen, or are we okay? Well, I'm in the habit of asking this because, well, just a habit.
No questions from me.
Okay, Riyadh, thank you. Right. What do we do next? We will look at the second model in the dividend capitalization approach. Let's clarify a few things related to that first, and then we will utilize the model. Within the dividend capitalization approach, then the next scenario is that we assume that the dividend grows, but it grows at a constant rate, constant growth rate model. Right, and we will call this growth rate G. And we saw the formula before. If you have to find out the price or the value of a share of stock today being signified as times 0, then you will write the dividend expected in the next period, that is D1, and divide this by a difference between the required return, KS, and the growth rate. What is important, what is key in understanding this is because it can be a source of error, needless errors, which are easily preventable. You should focus on these two numbers, please. One is this, and one is this, right? If you write a 0 here, then the dividend that has to be written here will be for the next period. So that if I had asked you to find out the value of a share at the end of time period 2, so the moment you see that the denominator here is, the subscript is 2, it tells you immediately that on the right-hand side, the formula will have D on the next digit, 3. Because if this is the present moment in time, then the future begins from the next time period. That's one. The other thing, the same thing can be expressed as follows. Should I write the whole thing or should we just talk about D1? Let's talk about D1 here. D1, because dividend is growing at a rate G now, which is constant, so we can write D1 as this, D0 multiplied by 1 plus G. So that if I rewrote this equation in this form, that would be equally valid. Right? Let's talk about this D3, this one. If I know D0, I can write D3 as this. So from time 0, it is going to grow for 3 more time periods. So third power. I could also have written D3 as this. Anytime you don't follow what I'm doing, you will please ask me. I could also have alternatively written D3 as this, depending on what data I'm dealing with. Suppose I know what is D1. Then I will see the difference between the time periods. 3 minus 1 is 2. So I will say the growth is happening for 2 periods. I could have also written this as D3 is equal to, suppose the data that I have gives me D2. Then I know the growth is happening for 3 minus 2, only 1 period. So all of them are correct expressions for D3. It depends which one will be used. It depends on what type of data you find yourself with, right? So for example, randomly, if I say, what do you expect the price to be at the end of time period 4? So your instant response can be this. But somebody, depending on the data, somebody might have written it as D0 into 1 plus G power of 5 Ks minus G. That's correct. Someone else could have written it as this also. So this is 4. Let me make the correction. Right, and somebody else could have written it as this too. So it depends what type of information or data. No questions? All right, let's take up an example. Let's take up a problem. Here, hello, is my voice carrying through? Are you able to see my screen? Anybody can give me an indication if you can hear me?
Yeah, that's your screen, sir.
Okay, all right, thank you. Right, so then let's move to the next problem. Problem 7.8. This is from, again, end of your chapter. And as you can say, it deals with finding the value of a common stock using the constant growth model. There are 5 iterations. I can do 1 or 2 of them with you, and then you can just give yourself a practice right away with one or two of them. Use the constant growth model or the Gordon growth model to find the value of each firm shown in the following table. So, for example, for this one, if we are trying to find the value for this firm's stock, and we can say price of the stock for firm A at time 0 is equal to, well, we have to be mindful. It says dividend expected next year. So the value for D1, so this is D1 then, is given already, right? So 1.20 divided by the required return, which is this is your KS, and this is your growth rate G. So 0.13 minus 0.08. So it will give you 1.20 divided by 0.05, $24. Likewise, if you do this, price of B at time 0 is dividend expected next year is 4 divided by the required return is 15% minus the growth rate expected is 5%. So 4 divided by 0.1 is straightforward, 40. Like this, you can find out the price of C at time 0 is the dividend is 0.65 divided by required return is 14.14 minus the growth rate in dividends is 10%. So 0.65 divided by 0.04 will give us $16.25. Like that, it can proceed. If you want to try it out right now for D and E, you can. Otherwise, you can do it later at home. What are you doing? Are you doing it right away, or will you postpone it for later? Because if you're doing it right away, then I will hold on for you. Otherwise, proceed ahead. So what's happening? Are you doing it? Folks, you have to tell me.
So good night. You can proceed ahead.
Yeah,
Okay, Shane.
go ahead. I finish it. I will.
Okay, all right then. Right, so let's look at the next problem, problem 9, again from the end of your chapter. It is again using the constant growth model. Let's see what it wants us to find out. McCracken Roofing Inc. common stock paid a dividend of 1.20 per share last year. Last year, when you read something like this, last year, then please treat this, because this is not next year, so treat this as T0. The company expects earnings and dividends to grow at a rate of 5%. So this is your growth rate. For the foreseeable future. Part A, I've just taken up part A is because the other parts are similar. They just change the data and that's all. What required rate of return? What required rate of return for this stock would result in a price per share of $28. So this is P0. Price is given. The required rate of return, KS, is what is supposed to be calculated. So KS becomes the subject of the computation, and that's it. So we can rewrite P0 is equal to D1 over KS minus G. We don't know what D1 is here, but we know that, so we will rewrite this as P0 is equal to, in this case, D0, which we know is 1.20, and it is supposed to grow for one period so that it becomes D1, and then divided by KS minus G. All right, and then we can just substitute the numbers and find out the value of KS. This is what needs to be done. So maybe so D0 times 1 plus G, well, let me just leave it like that for now. So we can just plug in the numbers. D0 was what? 1.2. 1 plus, what was the growth rate? 5%. Price, $28 plus growth rate. So if you carry out this calculation, it will lead you to this kind of thing. The numerator will become 1.26. And this will give you this fraction will become 0.045. So 9.5% is the required return for this particular scenario, right? Easy enough. Right, so if there's no question, thank you. So if there's no question, I will move on to the next problem, which is problem number 10 from the end of your chapter. Problem 10, let's see what it asks us to do. It's again based on the constant growth scenario. Elk County Telephone has paid the dividends shown in the following table over the past 6 years. So this data runs from 2007 through 2012, and for all these years, dividend per share has been given to us. Then they say the firm's dividend per share next year, which will the next year. So this timeline starts at 2007, ends at 2012. So which means the next year would be 2013. So the firm's dividend per share next year is expected to be $3.02. So then that means that this will become D1, because this is dividend next year. If you can earn, so I'm reading part A, if you can earn 13% on similar risk investment. So what does it tell you? See how they phrase this thing. If you can earn 13% on similar risk investments. Folks, I'm asking you this now. If you can earn 13% on similar risk investments, how much would you want to earn from this one? You would want to earn the same 13% from this one also, because something similar to this out there gives you 13%. So why not this one? So the moment you say, well, that from this investment, Elk County Telephone shares, if I purchase from this also, I will need to earn 13%. Then that 13%. So once you say I require to earn 13%, so this becomes your required return. Yes, it's just that they've expressed it in a different way. The question is, what is the most you will be willing to pay per share? So P0 is what is need to be determined. So, okay, but they haven't told us. We can look at this table and realize that the dividends are not same. So it's not a case of constant dividend throughout the time. Dividends are changing, so they must be growing at a certain rate, but the growth rate has not been given. Instead, they have given us the value of the dividends over time, but we can use this to calculate the growth rate in dividends. You all have financial calculators. So I'm giving you the inputs. Please plug in those inputs and give me the readout from the calculator, please, if you can. I can also do it manually. I can set it up manually. If you want to use time value tables, that can be done too. Now, first of all, the calculator thing. So we are first of all trying to figure out the growth rate, because the price cannot be computed because the price is equal to this. So you can't have two unknowns. So this is what they want us to find out, but they have not told us what this value is. So we will figure out what this is first. So on the calculator, what you will do is watch, let me change the color so that you can clearly see what I'm trying to tell you. This reading, this value here, the most ancient of all values, the very, very distant past, you will assume this to be the starting value. So starting value is always the present value. So you will assume this if you're doing it on the financial calculator. You will say PV is equal to 2.25. And the most recent value in the timeline, that is 2012, which is 2.87, you will take that as the future value, because if this is present and you're looking ahead into the future, at the end of the time, you see this year happening, and corresponding to this year, we have this value. So that's our future value, 2.87. But remember, in the calculator, you cannot have the present and future value both with the same sign. So since we put in present value as a positive number, make sure that you use this one as negative value. Otherwise, you will get an error. Then we need to see how long this timeline is for. So 1, 2, 3, 4, 5, 6. Okay, so we are standing here. So this must be 0. So this is 1. This is 2, 3, 4, 5 time periods ahead. So n is equal to 5, right? And we need to find out the rate at which this whole stream is growing over time. So the rate on your calculator is given as I over y, interest per year. So that can be computed. Unless you want me to fire up my calculator at my end, if you have it handy on your phone, can you give me a readout of that, please? What is the value for IY? Anybody? Just waiting for the value. Otherwise, let me fire my own one. Second function, clear TVM. And then what did we have? We had 2.25 to go into the, 2.25 to go into the present value. And then we had 2.87 negative go into the future value. We had time was 5. And we wanted to compute the rate, which is interest per year. 4.9881. So that's approximately 5%. So we will take that 5% here. Did you all get that too on your machines? I don't know.
Yes, sir, got that.
Okay, Shane. All right.
I couldn't find my calculator when I was playing with it, and she had it, so I was scrambling for it.
Okay. All
But I
right.
don't mind it. Yeah.
Okay. Okay. For anyone who doesn't want to use the financial calculator, I'm just changing the color and writing the manual version of this, so you can use maybe this formula: future value of a lump sum is equal to present value multiplied by the future value interest factor of $1 raised to the power of time. And we can just substitute here. 2.87 is equal to 2.25. 1 plus the rate is something that we need to find out. Raised to the power of 5 time periods. So we can say 2.87 over 2.25 is equal to 1 plus ks to the power of 5. So we can write, because we want to use the time value tables, we can, the value for this will be 1.276. And this thing is nothing but the future value interest factor of $1 at k% for 5 time periods. So we will go to this table, future value interest factor table. You know, it's laid out like this. So here is your periods n, and 1, 2, 3, 4, like that. And here are your percentages: 1%, 2%, 5%, 10%, like that. And here are the interest factors. So in the row for the 5th period, because there are 5th time period is what we are interested in. In the row for the 5th time period, we will try to locate a factor which comes closest to this value, 1.276. And we know that it will be this. So you will find it here, 1.276. And you will read the corresponding rate, 5%. And then from here, you will say that this is equal to G. Right, so that's also a fairly simple process. It's just that you will need a time value table. Okay, so the original question was what? The original question was, if you can earn 13% on similar risk investments, what is the most you would be willing to pay per share? So let me change to color blue and write it here. So now we have the inputs to get to P0. P0 would be equal to, what is the dividend next year? Dividend next year, D1, we have labeled it here, 3.02. The required return we know is 13%, because that's what similar risk investments offer. And minus the growth rate, we have figured that out just now, 5%. So it's 3.02 divided by 0.08, and this will give you approximately $37.75. Part B is again similar. If you can earn only 10% on similar risk investments, what is the most you will be willing to pay? So you will just make a change. Instead of 13, you will write 10, and that will be it. So P0 would be this then. This, if you run through the calculator, will give you this. So this is as simple as that. All right, let's see, what do we have here? So was there any other question? Part C had said, compare and contrast your findings in parts A and B and discuss the impact of changing risk on share value. You know, we have established that relationship before in a previous problem, that as your risk perception increases, then that will lead to an increase in the required rate of return. And if the required rate of return increases, the share price will fall. Of course, the opposite will be true as well. If you start feeling that this particular investment has become now a little bit safer as compared to what it used to be, so that now you require a lesser return from such kind of an investment, like in this case, the required return has gone down from 13 to 10%, then as the risk perception declines and the feeling of safety increases, that is reflected in a lower value for expected return or required return. A lower value for required return should lead you to a higher price. So that in part A, when we had calculated the price, it was $37.75. In part B, we got $60.40, an increase in price because the required return went down. Why did it go down? Because the risk perception declined. Right, so this is now, the next one is problem 11, and this is going to take us into the variable growth model, for which we will use the understanding acquired thus far, but we will have to use it a little bit smartly, and for that, we will need to be a little bit attentive. Newman Manufacturing is considering a cash purchase of the stock of Grips tool. So it's another one company thinking of buying the share in some other company. During the year just completed, Grips earned 4.25 per share and paid cash dividends of $2.55 per share. So what are the values of interest here? Well, this is what they earned total, so earned per share. So this is actually EPS. We don't need that, but we can identify it based on our knowledge. Earned this much per share, so this must be earning per share, earning per share. We don't need that though. And out of this earning per share, they decided that out of the $4.25 that they're earning on a per share basis, they will distribute $2.55 out of that in the form of dividends. The remainder, of course, they will retain, right? So this becomes a value of interest for us. And when did this happen? During the year just completed. So this is not something about the next year. It's about something that has been done and dusted already. So this is, we will treat this as D0. Grips's earnings and dividends are expected to grow at a 25% per year rate for the next 3 years, after which they are expected to grow at a 10% rate per year to infinity, which means for the foreseeable future, of course. So this is a two-stage valuation model then, because there are two growth rates involved. So we will, for the first 3 years, we will use this growth rate. So because there are two growth rates, we will label them accordingly. We will call this the first growth rate, G1, which will be applicable for the first 3 years in our timeline. And then 10% per year from then onwards, we will call that G2. The question is, what is the maximum price per share that Newman should pay for Grips if it has a required return of 15%? So this is again a number of interest. This is a required return. So this is an estimate of KS. A required return of 15% on investments with risk characteristics similar to those of Grips. So ladies and gentlemen, what I suggest you should do in a situation like this is to have a visual of the situation. And to have a visual of the situation, you should do a timeline. So let's do a timeline. This is time 0. We know that here we have D0 is equal to 2.55. Well, let this be time 1. And here we need to have an estimate of dividend 1. This is time 2. Here we need to have an estimate of dividend for this time period. Here we have time 3. We need to have an estimate of dividend at time 3, right? So we are going to divide the timeline into 2 parts. So this one, let's treat this as the first part of the timeline. For the first, because it said first 3 years is a different growth rate. After that is another growth rate. So the first part of the timeline will look kind of like this. Let's add more details to the first part of the timeline and also note down key information. During this phase of the time, our dividends will grow at a rate called G1, which is 25%, right? So let's write down the values. So if D0, this thing, D0 is 2.55, then what should be D1? D1 should be, D0 multiplied by 1 plus G1. So this should give us 2.55 multiplied by 1 plus 25% of that. So this will give us how much will this be? I'll have to check. Let me pull up a calculator quickly. $2.55 multiplied by 1.
0.61.
How much? I'm getting 3.19.
Oh, I put 0.025. 0.25. Yeah. My apologies.
So 0.025 will be 2.5%. So this is 3.19.
Yeah, 3.18.
Like that. Let's proceed slowly and carefully. D2 will be given to us by, you can try both ways. I'm doing this D0 into 1 plus G to the power 2, which will be 2.55, 1.25 to the power 2. We'll have some value here. Alternatively, you can do this also and check if both methods give you the same thing. They should. Alternatively, you could pick up, now this is the value for D1. So you can pick up this value and say D2 is equal to D1 times 1 plus G. And plug in the numbers, 3.19 multiplied by 1.25. Either way, we should have the same result. Is anybody doing that, or should I do it here?
3.98.
Correctly, can you say it? Feed boots.
So 1.25 to the power of 2 is
3.98.
1.5625 and multiplied by 2.55.
3.98.
3.98, yeah. 3.98. And do we get the same thing here too?
Well, if you're wrong, we can
Yeah.
say 3.99.
Yeah.
Okay. So let's just say 3.98 then, round it off. So either way, you could have done this or you could have done this. Likewise, we can figure out what D3 is going to be. So either way, you could start from D1. You could do three things here if you wish. You could do this. You could do this. Or you could do this. All three formulations will give you the same value. A little bit here and there, but the same value. So I'm picking up this one just randomly because I know D2 is equal to 3.98. So I'm saying 3.98 times 1 plus the growth rate. That will be, let's check. 1.25, 4.98. Someone's mic is open. John, maybe. So we have estimates of D1, D2. No, let's just label them here and then we'll write them out neatly. And this is D3, right? So this part of the second part of the timeline will be this. We are not done with the first part yet. We will return to it in a moment. But just for the sake of presenting a visual, this begins. The first part ends at time 3. The second part of the timeline during which the growth rate will be, what was the second growth rate? 10%. 10%. During this part of the timeline, which will start from time 4 onwards, 4, 5, and then on till foreseeable future. The growth rate will be constant. So you realize that during this part of the timeline, if you're carefully seeing it, during this part of the timeline, going up till an unforeseen future, indefinite period of time, this part of the timeline is characterized by a constant growth phase, right? Which goes on and on and on. So during this part of the timeline, we will have the formula which we have been using for the constant growth model thus far. You may very well ask a question that during the first part of the timeline, when we were talking about D1, D2 and D3, didn't we have a constant growth rate at that time? 25%? The answer is yes. But then this part of the timeline had a finish point. At time 3, it finished. The formula that we had looked at earlier, if I can change color to this one, I don't know whether you'll be able to see. This formula that we have been using for constant growth rate model was based on the assumption that the dividends grew at a constant growth rate on and on and on till an indefinite period of time. In the problems that we solved earlier, everywhere it was written till a foreseeable future or something like that. Isn't that so? So that when this formula, if we try to derive this formula, we said that this will be a series which will keep growing at a constant rate on and on and on till infinity, and therefore it will become an infinite geometric progression. And then we will just take a sum of that infinite geometric progression, and then it will, after a little bit of manipulation, it will become as small as this. So this formula can be applicable not only when the growth rate is constant, but then this constant growth rate has to carry on and on and on. But if the growth rate is constant here, like here it's 25% throughout the timeline, throughout this section of the timeline, it's constant, but then this time period has a definite ending point. It is not an infinite period of time. It ends at time 3. So this formula here cannot be used for the first part of the timeline, the red part of the timeline, that is, right? So that is why we have had to figure out each dividend individually first. So this is D1, we figured out separately. We figured out D2 separately. We figured out D3 separately, right? Now what we will do with these dividends. So we are still dealing with the red part of the timeline, which is the first part of the timeline. The conclusion of the first part of the timeline is this. Timeline part 1, let's write. Let's write down our conclusion. This timeline starts from, well, let's tabulate it. Let's start at time 1 and goes to time 3, right? This is, let's say, dividends. Dividend at time 1 is what it was equal to 3.19. Let's write that. Dividend at time 2, 3.98. Dividend at time 3, 4.98. But folks, remember, if this was the only timeline that you're dealing with, then it would appear as this. A horrible drawing skill, but I think you'll get the message. This is time 0. This is 1. 3.19 is what you get. This is 2. 3.98 is what you get. And this is 3. 4.98 is what you get. You're standing here. This is your vantage point, time 0, trying to figure out the value of the stock today, which is at time 0. And you're looking out into the future and you're seeing that in the first iteration, you get this, but this one happens 1 year later. So this has to be brought back to this moment. This iteration, you get 3.98, but this, to know what is the actual worth of 3.98, which will be received 2 periods later, how much it is worth in today's terms, you need to bring that back here, and you need to bring this one back also here. So what we need to do is you need to find out the present value of these things. So we can find out the present value of these things, right? 3.19 divided by, you can do 2 things. I don't know how good you have become with time value of money. I have no idea how much practice you have done. You could do this 3.19 multiplied by the present value interest factor of what is the rate, required rate in this problem. It is here, KS is 15%. So you could write it this way, 15% for the first period, and look up the value in the table, right? And multiply it with 3.19. Alternatively, let's just erase this for the time being. Alternatively, you can just use the calculator where you can say that this future value is 3.19, right? Time is just 1 period ahead, right? I over Y is 15%. You're right, and then you can ask your calculator to give you compute present value. That is another thing that you could do. One way is this, second way is this, The third way is just to use the formula for PVIF. So this is one of the ways. This is the second way. This is the third way, where you can say 3.19, well, divided by 1.15. That can also give you the result. Whichever way you want to do it. I mean, there will be minor differences because of rounding offs and so on, but you'll get roughly a similar result. So I'm just doing 3.19 over 1.15. 3.19 divided by 1.15. That gives me approximately 2.77. The computer calculator just keeps on showing digits and digits. 2.773913043478 and so on. So I'll just pick up the two places after decimal. So this is the present value of the first dividend that we receive. We need to retain this. Second time period, we received how much dividend? 3.98. And we will calculate its present value, because what are we wanting to do after all? We are wanting to find out the present worth of the stock so that we know how much to pay for it. So 3.98 will be incoming 2 periods from now. So what is its present worth? Again, any of these 3 methods can be used. I am just doing this randomly. I'm picking it up. 3.98 divided by 1.15 to the power 2. So if I do this on my calculator, what will I get? 1.15 to the power of 2 is 1.3225. I'm going to take a reciprocal of that and multiply this with 3.98. So that gives me $3.01 approximately. And then the third dividend that I received, which is the end of the first part of the timeline, 4.98 is what I receive. And so I will calculate its present worth. So give me a second. Let me do it here. 1.15 to the power 3 is this, and I'll take the reciprocal of that, and then I'll multiply this with 4.98. That gives me 3.27 or 28, something like that. Let's say 27. Right. So since now I am done with dealing with the first part of the timeline, this is where I finish dealing with the first part of the timeline. So let's just review the first part of the timeline. What did we do? First of all, we noted that in time 0, this much was the dividend that was paid, 2.55. And we know that during this part of the timeline, the first part, that is the red part, dividends would grow at this rate, 25%. So factoring this in, we calculated what would be the value of D1. We got this. Then we calculated what would be the value of D2, which would be this one. Then we calculated what would be the value of D3, which would be this. Having calculated these values, we realized that though we will get these dividends at different points in time in the future, we need to know how much they are worth in today's terms, which meant that all of these 3 items, 3.19, 3.98, and 4.98, must be taken back to time 0 by discounting them or by computing their present values. So that became our next task, where we did it in this particular iteration. I've done it through a table format, maybe because that kind of organizes your work a little bit. So we just noted down the first 3 time periods here. We wrote down the corresponding dividends that would be received at those time periods, and we calculated the present value of all these 3 individual items, right? And for computing the present value, we could use it. If you preferred this way, the first one, you would use the time value table. If you prefer the second way, you would use the calculator, financial calculator. If you use this way, you could use just the normal calculator. Either way would work depending on your preference. What I did was I just used the normal calculator for all the 3 computations and got these as my present values, which means now that from this vantage point, time 0, looking ahead 3 periods ahead, I know that all these receipts will have a total combined worth of, well, I can add them up and find out how much this will be. 7 and 1, 8 and 7, 15. 1 and 7, 8 and 2, 10. And then 2 and 1, 3 and 3, 6 and 3, 9. $9.05 is what. If my timeline finished at time 3, then $9.05 would have been the price of this share. I would be willing to pay $9.05. But then the story doesn't end here, because this was only the first part of the timeline. Now let's bring in the second part of the timeline, right? So this was the first part of the timeline. 0, 1, 2, 3. And we have figured out that during this part of the timeline creates this much value for us, 9.05. After this, from time period 4, well, let's just use black, time period 4, 5, 6, and on and on. This time period has a growth rate of, what was it? Let's check back. 10% growth rate. 10% growth rate. This is G2. So we don't need to worry about this part. This is done. So I'm just going to cancel that out. We don't need this anymore for now, because we want our entire focus on this section of the timeline. Because this section of the timeline, we know that the result is 9.05. We have retained this. And we will find out the value that comes to us from the second part of the timeline. That we will add the two values that will give us the price of the share. So this part of the timeline, now we are at this vantage point. Period 3 had just finished. Period 3 has just finished. And we are looking on into the future, right? If this is where we are standing, on the timeline and looking ahead into the future, then this will allow us to determine the value of this share at this point in time. What is this point in time? What is this point in time? This is just the end of period 3. So we will be able to establish the price of the share at time 3. So, and using the constant growth rate, which goes on till forever, we can use the constant growth rate formula, where if we want to find out P3, then on the right-hand side, my dividend here should be 4, the next period's dividend, 4. And then, which I should divide by the required return, KS, minus the growth rate applicable to this part of the timeline, which is G2. So these are the things that I have noted. Let's compute P3. For P3, I will need to calculate D4. So first of all, let's figure out what D4 is. D4 is going to be, because I know D3, so I can say 1 plus the growth rate. But which growth rate? Here is where you will need to be careful, because moving on from the third time period, now because you're no longer going back, you're going ahead in the timeline. So you're moving this way. So between year 3 and year 4, then the growth rate applicable would be 10%. So G2 is the growth rate applicable. The value of D3 I can pick up from my previous table. D3 was 4.98 here, see? So I can say 4.98 is this, and then 1 plus the growth rate for the second part of the timeline. If I do this, then I will get 548. So once I've figured out D4, that will allow me to give an estimate of P3. P3 will be then D4, which is 5.48, divided by my required return, which is, in this case, if I'm not wrong, 15%. Just check. Yeah, 15% is the growth rate, the required return. And the growth rate in this part of the timeline, the second part that is 10%. So if we do this, let me have a page anyway. If we do this, 5.48 divided by 0.05, let me do that quickly and see. 5.48 divided by 0.05 gives me $109.60. right? Let's put this value in perspective on the visual. $109.60 is the value of the stock at this point in time, folks. This point in time. I hope you're observing this carefully at time 3, but we are not interested in determining the value of the stock at the end of time 3. The question that has been asked is, what is the value now? Whatever dividend we received here, we took it back to time 0. Whatever dividend we received at time 2, we took it back to time 0. Whatever dividend we received here at time 3, we took it back to time 0 and added up everything to get here 9.05. Remember, we did that earlier. Likewise, now at this point in time, at this point in time, the value created for us, P3, is equal to this 109.6. So this value 109.36, 109.6 also needs to be taken back to time 0 so that we can have the current worth of this thing. So what we will need to do, we will use this present value of 109.6. So we will discount it 3 periods back so that from time 3, it goes back to time 0. So this is equal to 109.6, and we will discount it for 3 periods. So let's just do this discounting. 1.15 raised to the power 3. This is reciprocal multiplied by 109.
2.66.
72.06 is what I'm getting. That's what you said?
60, again 62.
Okay. Okay, because I'm doing at on the computer's calculator, so maybe.
Again, it's 72.06.
Okay, that's what I got as well, 72.06. So looks like people got really tired of this today. Many of them have left. 72.06.
Yeah, correct. I got it. All right. I have a question when I finished it because I was using the calculator for the timeline part 1, and I was not getting the answers though.
You weren't? We'll check that out. Let's finish this first. So let's just again have a visual. Neat visual this time. 0, 1, 2, 3, right? And then this thing goes on. So at this time, let's just note down the values. 3.19, 3.19, taken back. 3.98, taken back. 4.98, taken back. Also at this point in time, we had 109.6 taken back, right? So this thing taken back, this thing taken back, let's just change color. This thing taken back to time 0, this thing taken back to time 0, and this thing taken back to time 0. All these three gave us a total of 9.05. And this thing taken back to time 0 gave us a value of 72.06. So what do we have? P0 equals 72.06 plus 9.05. So that's about $81.11. This is the current price of the stock. So a long process, but you get there eventually. Right, for now, the question that you asked, which one, where should I go and stop here? Here, this is the part you're referring to?
Yes, just try the T1, yeah, the first one, because I pay it in and I put computer again for that again negative.
Let's check. I don't know if this calculator will move for me or not. Give me a second. I'm just trying to improve the logistics at my end so that I can see what's going on. Did you also see the calculator move?
Yes, correct.
Yeah, okay. So let me clear out the previous calculation and let's just check out this one. So we say 3.19 is our future value, 1 period ahead. So 1 is n, and the discount rate is required return 15% is this, and then let's say compute present value and see what it says. See, it says 2.77. That's what we got. Folks, at this time, I have a choice for you. There's question number 13 on the list next, which is a similar question to the one we just did. Would you want to do it here by yourself and then check the answer with me later on? Or would you like to take it home and do it and later on come back with the result and check it with me? Either way, because after this, we need to deal with the free cash flow model as well.
The latter, sir.
You will want to take this home?
Yeah.
Okay, so if you're taking this home, then the correct answer for this, or at least the one which I got, is that the P0 for this will be approximately $34 and some cents. I have 12 cents, but yours might differ a little bit, depending on how many decimal places and which method of you're using, financial calculator or scientific calculator or time value tables. All of these things create minor differences, immaterial, but minor. Right, so this is a guidepost that you have that if, when you decide to solve this based on the procedure that I demonstrated with number 11, problem 11, then you should arrive at this answer, approximately $34, right? There will be again 2 parts of the timeline you can see. So where it says the most recent dividend was 1.80, so this will be your estimate for D0, right? And this is your required return, so this number is your KS. And then it says expected to grow at 8% annually for 3 years. So this is an estimate for your G1. And then after that, the growth rate will settle at 5% constant annual growth rate from years 4 to infinity. So this is an estimate for G2. So just like we did before, you will just change the numbers and follow the same procedure to arrive at approximately this result. Right. Let's proceed. Let me again change the logistics of my screen a little bit. Give me a second. Right, so what do we have next? We have problem 15, which is going to be based on based on the fact that we have a non-dividend paying company. So what we are going to do is we are going to follow the free cash flow approach. So let's change to black here. Free cash flow approach. We are going to follow the same procedure, same assumptions, same everything. Instead of getting the value on a per share basis like we have been getting thus far, we will get a consolidated combined gross value for the whole firm. We will call that VC. What we will get is VC, value for the company, right? How we will get this is like this. The general valuation model, instead of D1, D2, D3, it will become free cash flow in time period 1, discounted, right? But this time it will be discounted. But when you will look at your textbook, you will see that instead of KS, they will start calling it KA. We'll talk about that in a moment. And then again, free cash flow in time 2, we will need to bring it back to the present moment. So we will discount it by using this discount rate called KA, right? And so on, it will go on because the company goes on. So the cash flow stream goes on. So this is a general valuation model. Why there is a change from letter S to A here at this place? This is because when we were using the dividend capitalization approach, you will need to realize the fact that when you start thinking in terms of dividend, what comes to your mind? Equity shares come to your mind, right? So shares, S for shares is what was used at that time. K was used to indicate the rate applicable to, specifically applicable for something related to shares. So that was called KS. Here we have changed it to KA. The letter A wants to talk about a word called overall. So from the overall, it picks up the A from here, right? It says, because when you wrote dividend here at the top, you were thinking about equity shares. So that's why the discount rate was called KS, S for shares. But if you write free cash flow at the top, this does not belong to only the shareholders. Remember when we were in chapter 2 and we were calculating the free cash flow, we said that it was comprised of two things. I don't know whether you remember or not. Free cash flow was also known as the cash flow from assets, and it was equal to two things. It was the net cash flow to creditors, net cash flow to creditors, plus cash flow to the stockholders. So it was not only the stockholders that were involved, because if it was only the stockholders, we would have used this S, which would come here. So, but this time when we talk about free cash flow, it's not only the stockholders who are in the picture, but our creditors also are in the picture. Creditors are also in the picture. Creditors are who? If these are the equity guys, then these are the debt guys. These are the people to whom we owe money. So it's the whole set of stakeholders that is at play here when we talk about free cash flow. So whole set of stakeholders means the whole company is being talked about. That's why we have written here the whole company is being valued here, right? And the free cash flow belongs to the whole company. And so therefore, we should use a required return which does not represent only the shareholders alone like this. Like, for example, when we were doing bond pricing, the rate of discount that would have been used there was KD, because D stood for debt at that time. When we used dividend models, we used S because S stands for shares. So these were specific components of the total picture. Now we are using the whole firm. We are valuing the entire company. And so therefore it includes the debt holders also, it includes the shareholders also, everybody. Free cash flow belongs to everybody, whole company. So it is the overall cost or overall required rate of return that has to be considered. That's why the letter A. And this has another name, KA, is known as, when you go to a future chapter, we will learn this is the weighted average cost of capital actually. So I've given you this term just for reference for now, but later on you will read more about it, if, well, time permits. So we will follow exactly the same procedure that we have followed thus far, and I will compute with you. And what we will end up with will be the value for the whole company, right? But as we said, the whole company is, well, in a company you can have equity shareholders or common stockholders, let's call them shareholders. In a company, you can also have preferred stockholders, preferred shareholders. In a company, you can have debt holders also, people from whom you borrowed money. Right? So many kind of stakeholders are there. And all of these guys have an interest in the company. All of them are looking on. The whole company, this is the set of stakeholders. At least if we take out the employees and the customers, who we are not talking about here. So if we find out the value of this whole thing, this value belongs to all of these guys. But if we want to find out what is the value for the shareholders, what we need to do from the whole thing, we need to if we want to find out the value for the shareholders, that is, let's say VS is what we want to find out, then we'll take the whole value of the whole thing, and from this we will subtract the value for the debt holders, the value for the preferred stockholders. What we will be left with will be the total value for the equity shareholders. And then the price per share or the value per share will be this. divided by, I'm just writing N here, which simply means number of outstanding shares. That's all. So let's put it into use, this understanding. We'll look at problem 15. Never Industries is considering going public, but is unsure of a fair offering price for the company. Before hiring an investment banker to assist in making the public offering, managers at Nebar have decided to make their own estimate of the firm's common stock value. The firm's chief financial officer has gathered data for performing the valuation using the free cash flow valuation model. The firm's weighted average cost of capital, and I had talked about it a few moments ago, which we will use that as our required return. So this is then your estimate for KA. And it has a cost of capital is 11%, and it has $1,500,000 of debt. So this number is of interest to us because this will be the value for the debt holders. So we'll call that VD. And $400,000 of preferred stock. So this number is of interest to us. We'll call this value for the preferred stockholders. And then the estimated free cash flows over the next 5 years, 2013 through 2017, are given below. So in this text box, we have those values. We have the years here, and we have the free cash flows estimates here. Beyond 2017, so after this, if time were to go on, then during that part of the timeline, the free cash flow would grow by 3% annually. With this information, part A is asking us to find out the value of Nebar Industries' entire company by using the free cash flow valuation. And then in part B, they're asking us to use our findings in part A to find the Nebar Industries' common stock value. And in part C, they say if the firm plans to issue 200,000 shares of common stock, what is its estimated value per share? So we will tackle that one at a time. Folks, let me know, are you tired or are you feeling overwhelmed or something? Are you okay? Because everyone has left by and by, so the people have been dropping out. Adrian, John, Shane, you're the only ones still standing.
No, I'm okay. Just want to finish the question.
Yeah, so we
Okay.
can finish the question.
Okay. And at the end of it also, you have to please let me know the date for your coursework exam. Okay. So this is what we will do. If you will remember from before how we did it, we had a 2-part timeline like this. So maybe this is the starting point, and this is 2013, 2014, 15, 16, 17. And then this is where the first part of the timeline finished. And from here, the second part of the timeline started. In the first part of the timeline, in the previous problem, we had growth rate G1. We don't need it here. You realize that we don't need it here because growth rate in that problem was needed because we had to find out the values of individual dividends in the previous problem. For this problem, the values of cash flows are already given to us, so we don't have to really compute anything. We just need to pick up the values directly and calculate their present value. That's all. So the question of having growth rate 1 is moot here, so it's not needed. However, in the second part of the timeline, we will need a growth rate. The G2 will be required, which in this case has been given to us as being equal to 3%. This is where we will use our constant growth formula in this part of the timeline, the year 2018 onwards. So this will be the break-off point. So just like we did a table before, let's just organize the work for the first half of the timeline, this part, right? So let's just add a page and put this in view and just write down T is 2013, 2014. So I will skip the part of the calculation. I'll just supply you the figures because you know how to calculate it. What we want to do actually is to see now how the results will look like. Right, so this is the first part of the timeline. During this, previously we were writing here dividends. when they were available. Now what we have is free cash flow. So the first year was 200,000. Let's keep that in view. 200, 250, 310. Remember, in the previous problem, we had to calculate it first using the growth rate, but this time these values are given already. So then after 310, we have two more, 350 and 390. And then we have to, like before, find out the present value of this. Like, for example, this one, 200,000 divided by 1 plus the required return, which is KA. You see here, KA 11%. So this will give us a value like that. We will continue to do this. So like this, and these results will be as follows. This one will be 180, 180. This one will be 202, 900. When you do something similar here, it will be 310, 1.11 to the power 3. This will be 226, 672. Likewise here. Power 4, this will give us 230, 545. And the last one, 390,000. We discount that, finding the present value. Will give us 231, 426. So basically, it is just like doing this. The value that we had here, we had 200,000, 200K. We took it back to times 0. We had this value here, 250,000. We took it back to times 0. The value here also, we took it back to times 0. Value here also taken back, taken back. So all of the taken back values are these. And so that a sum total of all these is going to give us 1,071,723. So this will be the first part of the timeline, which is going to be faster now because the values, these values were known and we didn't have to deal with any kind of a growth rate or something like that. In the second part, now we will focus on this part of the timeline, the red part here, this one. What we will do, because now we will assume that we are here on the timeline. This is our vantage point, the end of 2017, and we are looking on into the future so that we can calculate the value at this point in time, 2017, by looking at what happens in the future after 2017. After 2017, what's going to happen? We will need to write the free cash flow for 2018, because that will be the first period in the future after 2017, and then we will need to divide that by the required return minus the growth rate during the second half of the timeline. So we can figure that out. So value 2017 will be, how much will be FCF 2018? It will be whatever the FCF was in 2017 multiplied by 1 plus the growth rate of 3%. So FCF in 2017 was what, 390,000? So if you do this, you will get 401,700. So I forgot to divide it by what was the required return, 11% minus the growth rate, 0.03. So then value in year 2017 is equal to 401,700 divided by 0.11 minus 0.03, which would give you 5021,250. This will be the value. But because this is the value at 2017 and what we want is the value for today, we will have to take it how many periods back? So we can count back from here 1, 2, 3, 4, 5 periods, 1, 2, 3, 4, and 5 periods back. So count back 1 period, 2 periods, 3 periods, 4 periods, and the 5th will take you back to the present moment here. So 5 periods. So from the second part of the timeline, this one, we write PV of value in 2017 is equal to 5021,250. We are taking it back 5 periods at the required return, 1.11 to the power of 5 time periods. So if you solve this, you will get around this value. 2,979,609.75, right? So this is what you get from the second half of the timeline. This is what you had gotten from the first half of the timeline, right? So just add the two up to get the full value of the company. This will give us 4,051,332.75. So this is the value of the entire company. In part B, they said find out the value for the shareholders. So because the total value of the company is this, so value for the shareholders will be the total value, and from which we will subtract the value for the debt holders, which was given to us, and from that we will subtract the value for the preferred stockholders, which was given to us. So this will be, we'll pick up this 4,051,332.75 minus what was the value for the debt holders. Let's scroll back up and see. Value for the debt holders was here, $1,500,000 here. 1,500,000. And from this, we need to subtract the value for the preferred stockholders, which was, let's check that again. It was this $400,000 here. So let's put that in here, 400,000. And carrying out this calculation will give us a VS, the value for the total value for the stockholders will be $2,149,331. So this is for all the stockholders. In part C, they wanted us to get the value per share. And based on the fact that they will be issuing 200,000 shares, so we just need to divide. That would give you $10.74 on a per share basis. So that's how you can use the free cash flow model to first of all find the value of the whole company and then isolate the value for the shareholders. And then the value of shareholders can be divided by the number of shares to get a per share estimate of the shares value.